Grantor Retained Annuity Trusts. That's the topic of this InvestMinute in today's general finance lesson. How they work, are they useful, and why some may have a different opinion. I'm Jonah. I'm one of the banking bros at the Cash Compound, and I'm cracking the code today on this saving and investment product, a Grantor Retained Annuity Trust. So here's the concept applied. A grantor funds an irrevocable trust with assets expected to appreciate and retains the right to an annual income payment from the trust. At the end of the trust term, trust assets go to the named beneficiaries with little or no gift tax. And here's how it works. So the grantor transfers income-producing assets to the GRAT. The gift value is calculated based on the initial value plus a theoretical rate of interest, which sometimes is known by AFR. That interest is set by the IRS minus the annuity payments through the end of the GRAT term. If the assets appreciate at a higher rate than the AFR when the GRAT is established, the excess growth becomes a tax-free gift to trust beneficiaries. Now, a GRAT is zeroed out when the value of the annuity interest equals the remainder interest, so no gift tax is due. Here's your equation. Low AFR plus appreciable assets equals a really good time for a GRAT. Now, here's why it's useful. A GRAT can remove assets from the grantor's estate and significantly reduce gift taxes on assets transferred to beneficiaries with this caveat. Should the grantor die during the term, GRAT assets are included in the grantor's estate for estate tax purposes. Now, here's an example of how to use a GRAT. GRATs are mostly useful to wealthy individuals who face significant estate tax liability at death. In such a case, a GRAT may be used to freeze the value of the estate by shifting a portion or all of the appreciation onto the heirs. For example, if a person had an asset worth about $10 million, but expected it to grow to $12 million over the next 2 years, they could transfer the difference to their children tax-free. Now, if the grantor dies during the term of the GRAT, the value of the remainder interest is also included in the grantor's estate. However, the grantor can pass the right to receive any remaining annuity payments to their surviving spouse to qualify for the estate tax marital deduction, which could eliminate any estate tax liability relating to the GRAT assets. GRATs are especially popular with individuals who own shares in startup companies, as stock price appreciation for IPO shares will usually far outpace the IRS assumed rate of return. That means more money can be passed on to children while not eating into the grantor's lifetime exemption from estate and gift taxes. Now, here's why some don't like the plan. Under a GRAT, the annuity payments come from earned interest on the assets underlying the trust or as a percentage of the total value of the assets. If the individual who establishes the trust dies before the trust expires, the assets do become part of the estate of the individual, and the beneficiary receives nothing, making the GRAT useless. A successful GRAT also assumes that the assets appreciate. So if there's depreciation, the GRAT doesn't work well at all. There's also a risk with the IRS's 5720 rate in that it has been so low over the last decade as to reduce the ultimate advantage of using a GRAT in the first place. So here are my thoughts. It can be really tough to navigate if a trust is better for you than a will, if you should use a revocable trust or irrevocable trust, or you might watch this video and then realize, wow, a GRAT seems like it's for me. But is it really only for people that are super wealthy or that are involved in a startup? What about my established businesses? And I personally don't suggest you make these decisions on your own. My advice is to use a trusted professional when exploring these options. I absolutely love avoiding probate, avoiding taxes, and in most cases, those are the primary reasons for having trusts. On our channel, we teach the infinite banking concept, which also avoids probate and taxes in most cases. And if you haven't heard of that before, it's utilizing the guaranteed growth and cash flows from life insurance without any risk of market forces. And because these private banks are built inside of life insurance policies, that means that one day I too will be passing a substantial benefit to the next generation. The difference, of course, will be that life insurance proceeds are not considered ordinary income, and therefore we will have no concern of capital gains, gift, estate taxes. However, throughout our lifetime, we use the guaranteed cash flows from these life insurance policies to fund the purchases of income-producing assets. Those assets also must be passed on after graduation, and that's the reason why you might want to consider something like a GRAT if that fits your need. Now, you can personally click the link in the description of this video so you can see how you too can have guaranteed cash flows that you then use to purchase income-producing assets. So, are you ready for it in under 60 seconds? Here's your GRAT investment. A GRAT is an irrevocable trust that removes contributed assets from the grantor's estate. It provides the grantor with an income that discounts the gift tax value of the transferred assets, possibly resulting in no gift tax liability, and allows trust assets to grow without additional gift tax. You can subscribe to this channel and join me for my next InvestMinute, where I break down family limited partnerships.